Ticker symbol TDW is up around 16% in the past year, and today we'll be looking at a medium cap which is developing economies of scale, as it is a great growth machine with solid fundamentals, rising efficiency ratios, and its gross profit has grown by 84% in the previous year. So today we'll be looking at Tidewater, an offshore services company. In their annual report, they state that they provide marine and transportation services to the global offshore energy industry. They currently have more than 183 active offshore service vessels, which basically means ships that are used in the offshore services, serving customers in over 30 countries. So this is one of the largest players in this industry. Some of their services include, for example, the towing of mobile offshore drilling units, as the one you're seeing on the screen, transporting supplies and personnel, aiding in the construction of offshore projects, and other specialized services such as pipe and cable laying. So anything that has to do with a very complex structure in the middle of the ocean is what Tidewater specializes in. And the revenues are derived primarily from vessel time charter or similar contracts. These contracts range in duration from a few months to several years. And this is brilliant because it means that the majority of the revenues will actually be sort of as a subscription model. Since they are very long-term contracts, these help you with your customer retention rate. This allows the company to have a more secure client base and prepare itself better for the long term. In 2022, their 5 largest customers accounted for close to 36% of their total revenues, while their 10 largest customers accounted for 51% of all revenues. Now, this is something that we should keep in mind because it introduces some sort of risk, because when one of these top 10 largest customers actually decides to drop out or finds a more attractive offering, Tidewater will lose a big chunk of their revenues. And this is very risky as it can produce very big swings in the prices of these stocks. However, when we look at their financials, it looks like a solid company, as it has a return on capital employed of 10%. Now, we usually have a threshold for this ratio of above 15%. However, when we're speaking of an asset-heavy industry, as offshore services are because you have to own the vessels, then this 10% is spectacular because they're of course one of the leading companies in these ratios for their industry. Now, they have an interest coverage ratio of 4 times, which I would normally assume of it being very low. However, they do make up with the fact that their revenues and their income are extremely predictable. Next, they have a very solid cash conversion of 75%, which basically states how efficient they are at generating free cash flows. They have a very solid profit margin of 45% and an operating margin of 17%, which is great because in this industry, again, margins do tend to be quite thin. Now, the great thing about this company is that it is growing at a very fast pace. You can see that their revenues, their gross profit, and their net income have been growing every single quarter, with them also realizing an expansion in both of their current margins. And when we look at their efficiency ratios, of course, these tell a very similar story, with all of them rising accordingly, and return on invested capital, which is the one we usually like to see, sitting at a 12% currently, which is again a very solid place for it to be for a company in this industry. We can also see that this company has a current ratio close to 2, which basically means that they almost have twice the total amount of assets as they have total liabilities. Additionally, their equity is above their debt. These two ratios combined allow them to portray themselves as a safer investment in terms of their leverage position. But when we look at their fundamental analysis, this company actually gets a 4 out of 8. I'll start with the positive ones, which is that they first of all have a very solid balance sheet because they can pay off their short-term loans while only using their current assets. Then they're very, very consistent at generating free cash flows, and the positive thing here is that they're able to grow them organically. How? Well, most of this growth is actually attributed to the organic revenue growth that they are conducting. Organic basically means that they do not need to rely on M&A, on acquisitions or mergers in order to grow their top line. However, I don't like the fact that this company has high liability risk. They only have an interest coverage ratio of 4 times. They do not pay dividends, and they haven't been conducting share buybacks. So I believe the majority of their free cash flow actually goes back to maintaining, repairing their ships. And then I do not believe that they have pricing power, and I do not believe that they have an existing moat or competitive advantage. First of all, I do not believe that they have pricing power. Usually what happens is that big energy companies produce a tender, which is when a company actually requests suppliers to give them offers for a project. For example, if a company is building an offshore oil rig and they need suppliers to build it, then they will list the project and request suppliers to send them offers. Then, when they have received all the offers from their suppliers, they will evaluate quality and pricing, and they will select the one that fits them the most. I do not believe that they have pricing power because prices are extremely standard industry-wide. Now, in regards to their existing moat or competitive advantage, as I have stated previously, this is a very commoditized service. However, currently there are a lot of cases of new technological advances which are helping offshore services companies to use, for example, drones or submarines in order to, first of all, improve the quality of the offshore services that they will offer, but second of all, drop the prices by massive amounts. And in the end of the day, when you are conducting a tender, the main aspect that you focus on is to lower your cost. So you will select the cheapest supplier as long as the quality is more or less the same. Now, in regards to their valuation analysis, they have gotten cheaper over time with their PE ratio sitting at around 24 times currently. Additionally, they currently have a 4.3% free cash flow yield, which is a lot higher than the 3% long-term inflation rate. Both of these methods suggesting that this company may actually be trading at a discount. Now, when looking at the risks and possible challenges, I have mainly identified the worsening competitive landscape. As I stated, there are a lot of technological advances and a lot of new companies that are entering and revolutionizing this space, which could potentially hurt Tidewater, as they would offer, first of all, better quality, but most importantly, lower prices for big energy companies to actually consider them above Tidewater. But the second one is the market risk. Tidewater mainly works for big energy industry, and the main services that they offer are regarding offshore oil rigs. Now, these oil rigs are very dependent on the price of oil, of course, because it's the product that they're extracting, meaning that if the price of oil is too low, production, maintenance, and construction of these offshore oil rigs will actually lower a lot. So throughout history, both these industries, the energy industry and the offshore services industry, are extremely cyclical. Now, before we move on, please remember I'm not a financial advisor and this is not financial advice, so please do your own due diligence. However, I believe that this company does not have a strong competitive advantage and they do not have high return on capital employed. However, they do have consistent, predictable, and growing free cash flow, which is an extremely good thing for a company to have. So I believe that this is an okay company, and while it may be a good investment, it has high client risk, and I will not be conducting further analysis on this company. However, thank you for watching. As always, this has been the Cashflow Compounder. Please join the free Patreon for extra content, and there is a link in bio for a free stock if you join Trade Republic.